All right, let's talk about mortgages.
So, Mostyn, you've started thinking about getting a mortgage.
You can get your mortgage sorted out before you've even found a house.
Really?
Oh, yes. Saves wasting time once you have found a place. Another milkshake?
Don't mind if I do.
Chocolate topping?
No, well, I don't know.
Go on.
Perhaps just a little bit.
That's what I like to hear.
I'm Forrest Hewes with Community Mortgage Advisors. Basically, you're going to have these three things in order to qualify.
Baby, feel good. Hit me.
All right, Forrest, can you explain the big three: debt to income ratio, credit score, and steady employment?
I mean, you have to have a steady job, and the length of employment, it doesn't matter if you've been in the same job or if you've been in the same line of work, that's great. They want a 2-year window into your past to know how, where you've worked, how steady your income is. And you have to be able to show that your income can not only cover your mortgage, but then all the other debts that you have on your credit report. Everything that you have in your name is going to have to come within 45% of your gross income. If you know that everything that you have on paper equals 45% of your gross income, you're good to go. And in the mortgage world, 740 and above is considered A paper credit. That doesn't mean that you can't get a loan if you have lower than a 740, because you can get a loan all the way down to 620 for a credit score, but you're going to have to find, generally just the best rates and terms are going to come to those with a little bit higher credit.
Okay, second question. Can you get a loan if you're an entrepreneur or an artist or a gig worker?
You absolutely can get a loan when you're self-employed. The biggest thing that banks are going to look for is longevity, to see how long you've been self-employed and how you've performed while you've been self-employed. What the key number is for self-employed people is typically your adjusted gross income. So you're not receiving a W-2, you're reporting for yourself. So they want to see that after your expenses, you still make the money that still falls within those debt to income ratios that we previously mentioned. Take it easy on write-offs. It's so tempting as a self-employed person to write off everything as an expense, but at the end of the day, if you're looking to qualify for a house, you might want to go ahead and pay higher taxes and report those expenses. It's going to hurt maybe in the short end, but in the long run, you're going to end up being able to qualify for a house, which will ultimately probably be the most valuable asset that you have in your portfolio.
In a typical situation, how much down payment does somebody need?
A traditional conventional loan will typically require 5% or more down payment. There are other programs that if you qualify for from an income standpoint, that you can put down as little as 3% on a conventional loan. And then there are various government loans. Your FHA loans require 3.5% down payment at a minimum. And then there's other loans like USDA loans and VA loans that require 0%. So it really just depends on the kind of loan that you plan on obtaining.
Say I'm a little hard up. Can I borrow the down payment from family or a friend?
There are different avenues that you can go down where you can take down payment assistance from a relative. They can gift you those funds. And I've got documents that will help explain all that in a little paper trail that you can tie it all together for. It's really easy, actually.
Can you explain in the simplest terms what the hell PMI is?
It's private mortgage insurance, and you will incur PMI anytime you get a loan where you're putting down less than 20%. And a lot of people that are buying their first houses don't have 20% to put down. So there are options, like we said earlier, with 5%, even 3%, 10%, whatever. It's basically a hedge bet that the bank takes against your mortgage in the case of your default. The most traditional way of paying PMI is it's just added on to your monthly payment. There are creative ways that you can do it otherwise, where you can put down the whole amount up front and just get rid of it altogether. And basically, if you've been in a house for a couple of years and you've watched the property values around you increase, you can always call your lender and request an appraisal and an assessment to have PMI removed, because we live in a vibrant market where house values are going up at an accelerated pace by comparison to many other places.
All right, man, here is a question I hear a lot. So if I can't put down 20% and I'm gonna pay PMI anyway, and my loan only requires me to put down, say, 5% for a conventional loan, Is there an advantage to putting down more, like putting down 10% or 15%?
The obvious advantage to putting down 20% is that your monthly payment will be lower. But honestly, there are a lot of different ways to go about doing that. In some cases, you can put down 15%, 10%, and then buy your mortgage insurance out in full, which will end up making for a cheaper monthly payment and will also end up keeping more money in your pocket, which is the objective for me with a lot of my clients, is to, spend the bank's money as you need to and keep what you need as well.
So Forrest, as you know, the market in Nashville has been crazy, and 2020 was nuts. Interest rates are the lowest they've been in history, and we're seeing crazy demand still here in Nashville. What do you think is going to happen as far as interest rates and mortgages go in the next year or so?
Honestly, 2020 was crazy. We started the year at 4% interest rates and ended the year in the 2% range. It's unlike anything I've ever seen in my career. I don't know how long that can stay or sustain. Honestly, I don't anticipate them moving up anytime too soon, especially while we're dealing with COVID. But once we begin to turn the corner on that and the markets begin to get strength and people are back to work, you will see these rates begin to creep up. But for right now, it's been as good as I've ever seen in my career.
I can't recommend Forrest enough. If you're looking to see if you qualify for a loan, first time, second time, call him. He's the man. He's my go-to every time. He'll take care of you.